Hey everyone, and welcome to this explainer. Today we're putting on our financial detective hats and looking at a fascinating company through a strict Warren Buffett-style value investing lens. We're going to dig right into the earnings reports, the 10K filings, and the market data to figure out what's really going on with a business you probably think you already understand, but which is actually undergoing a massive transformation.
We're talking about Generac, ticker symbol GNRC. Now, for years, Wall Street has basically looked at this company strictly through the lens of severe weather, right? The power grid fails, people panic buy generators, and the stock pops. But if you look at their 2026 filings, there is a seismic shift happening right under the surface. So, the big question we have to answer today is this. Is Generac still just a cyclical weather play, or are we actually looking at a hidden AI data center giant?
Okay, let's just run through our checklist real quick. We're going to hit evaluating the business, assessing the moat, financial strength, risks and headwinds, and finally, the value verdict.
Let's jump right into step 1, evaluating the business.
So Generac was founded back in 1959. You can basically think of them as the Honda or the Kohler of backup power, but they are evolving and fast. Today, they're a global provider of these really broad energy technology ecosystems. Sure, they still make those classic residential standby generators you see sitting outside suburban houses, but they're also building massive large megawatt diesel and natural gas generators, energy storage systems, and full-blown microgrids for commercial and industrial markets. So they're actively transitioning from just being backup power to what they're calling powering a smarter world.
To really understand the mechanics here, you've got to split the business into two totally distinct engines. On one side, you have their legacy residential segment. This is B2C, heavily driven by unpredictable weather and power outages, and it made up about 53.9% of their 2025 sales. It's their cash cow, but it's incredibly volatile. Then, on the other side, you've got the commercial and industrial or C&I segment. This is B2B, and it is just skyrocketing right now. In the first quarter of 2026 alone, this segment grew an impressive 28% to hit $510 million. And why? Because they're selling massive power solutions to data centers to feed the AI boom. It's a highly predictable, high-growth engine tied directly to global tech infrastructure.
Let's move on to step 2 and see how this builds into assessing their moat. Now, for those of us using the classic value framework, we know an economic moat is just that structural advantage a business has over its competitors, the castle wall protecting its market share and long-term profits. So, does Generac actually have a moat? Well, the data points to a massive yes.
Just wrap your head around this number, 75%. Generac literally commands over a 75% market share in the North American residential standby generator space. That is an incredibly wide moat. They've built up a network of over 8,700 authorized dealers. When a homeowner decides they need backup power, Generac is essentially the default setting. Building that kind of brand dominance and distribution network, that takes decades, and it acts as a massive barrier to entry for anyone trying to muscle into the residential market.
Let's transition into the quantitative side with step 3, financial strength.
What's really interesting here is the operational leverage Generac is pulling off. In Q1 of 2026, their net sales went up 12% to $1.06 billion. But you really want to pay attention to that adjusted EBITDA margin expansion. In simple terms, their core operational profitability is growing way faster than their sales. Management was actually so confident in this data center growth that they bumped their full-year margin guidance up to a very healthy 18.5% to 19.5%.
And that margin expansion brilliantly illustrates what's happening on the bottom line. Net income attributable to the company in Q1 2025 was roughly $44 million. Fast forward to Q1 2026, it absolutely surged to over $73 million. So this isn't just top-line vanity revenue. We're talking about high-quality, profitable growth driven by real pricing power and that incredibly lucrative data center demand.
So what exactly is management doing with all this cash? Capital allocation is a huge piece of our puzzle here. Generac doesn't pay a dividend. The yield is literally 0%. Instead, they're aggressively reinvesting and buying back their own stock. In February 2026, the board authorized a new $500 million share repurchase program, which is a clear signal that they believe the stock is undervalued. On top of that, they're strategically deploying capital into M&A, like recently acquiring Allman for mobile power equipment and Enercon, specifically to beef up those data center power capabilities.
The crucial point here, though, is the health of their balance sheet. Their net secured leverage ratio is sitting at just 1.31 times.
That means their core earnings could pay off their secured debt in just over a year. That is a total fortress balance sheet. It gives them the breathing room to weather economic storms, keep buying back shares, and chase down M&A without overextending themselves.
Of course, no value analysis is complete without flipping the coin. Step 4. Risks and headwinds.
There are 4 core threats we absolutely have to monitor. First, despite all that C&I growth, over 50% of the business is still residential, meaning it's highly reliant on unpredictable severe weather. A quiet storm season literally translates to lower sales. Second, the clean energy transition. Companies like Tesla with their Powerwall battery systems are a direct threat to traditional fossil fuel generators. If battery adoption speeds up rapidly, Generac's core products could face serious obsolescence if their own clean energy tech lags behind. Third, we can't ignore macro consumer spending pressures. These are expensive products, and an economic downturn hurts. And finally, a big legal red flag. In Q1 2026, they had to record a $206.5 million reserve for a product liability settlement. While it's partially covered by insurance, it really highlights the operational and legal risks of manufacturing heavy machinery.
That brings us to our final section. Step 5. The value verdict.
Warren Buffett famously said it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So, is Generac a wonderful business? Well, it definitely dominates its legacy market with a 75% wide moat. And it has unlocked some massive, high-quality earnings growth serving these AI data centers. Management's capital allocation is really smart, the balance sheet is rock solid. But it still faces very real threats from battery tech and relies heavily on a fragile grid.
We've laid out the hard evidence directly from the source filings. You've seen the legacy weather-driven engine, and you've seen the explosive new AI data center catalyst. So now it's your turn to act as the portfolio manager. Based on this structural analysis, is there enough of a margin of safety here for you? Would you consider Generac a buy, a hold, or a pass? Take these insights, dig into the filings yourself, and keep hunting for that value. Thanks for joining me on this explainer, and I'll catch you next time.